Hello Proponomics people, and welcome to day 7 of the 2023 Proponomics Advent Calendar. Now today I'm going to be talking about the yield curve and its significance. So the yield curve is a concept that I talk about again quite a lot. And why do I? Well, because it gives us some clues as to what the market thinks is going to happen, not just in the near future, but also way out there in terms of even to decades length. So what is the yield curve? It is simply a graph that plots the various yields of different durations of bonds. If you don't understand duration and bonds, it's worth looking back at day 1's longer explainer video where I go into some detail about those. But we start with bonds that might mature in 1 month time, let's say. And remember, we're talking about government bonds here. So in the UK, we're talking about gilts. So we've got maybe 1 month duration bonds. They're going to mature next month, all the way through to 50-year bonds. Those are about the longest bonds that we have ever and do ever issue as a government, although there are some countries that have issued 100-year bonds. And it is simply plotting the yield of those bonds. Now remember, they're trading in a secondary market all the time. There's lots and lots of buyers and sellers. These are markets awash with billions of pounds worth of liquidity in general, although not necessarily so much on the slightly different dated bonds, like the 6-year might not be particularly popular, for example. But generally speaking, there's billions in transaction volumes in these on a monthly basis. So they're very efficient markets. And what this tells us is, what does the market think is going on in the economy over the next period of time? Now, why does it reflect what might be going on in the economy? Because it might well be the case, as has been over the last 12 months or so, that the market thinks there's going to be a recession relatively quickly. Now, that bond market might be seeing a recession 1, 2 or 3 years out. And of course, the market doesn't know how to time these things exactly. And of course, lots and lots of recessions have been predicted over the last few years, although we did have a technical one in 2020 when the pandemic shaved so very much off the GDP in such a short space of time. But we had a relatively V-shaped recovery where we bounced back nearly to the levels pre-pandemic relatively quickly. So back to the yield curve. What does it normally look like in a normal, nice functioning market? And I know we haven't had one of those for a while, but it looks like a nice steady curve sloping upwards like this and normally tapers off then slightly over time. So why does that happen? Because what we would expect is the shorter we commit our money for, so if we're going to put it into a bond and we're going to get the money back next month, there's very little risk involved. We've got a pretty good idea of what might happen over the next month in the economy, so we'd expect a smaller return for doing that. Now, if we lock it away for longer, there's obviously lots and lots of things that are going to happen. There'll be 7,000 crises according to the media, and probably 2 or 3 really significant economic events if we're talking about a period of, say, 10 years, for example. So we'd expect more as investors for locking our money away for longer. And that's a normal looking yield curve. Now, we've experienced the other 2 types of yield curve relatively regularly over the past few years. One of them is the flat yield curve. So there's not really any premium for locking your money away for longer. That's much more likely to happen when rates are particularly suppressed. So there was a time when very, very few bonds, apart from particularly long duration ones, were returning much above 0%. And that was sort of 2021 times, late 2020 to early 2021, when things really were very flat. And then the inverted yield curve, which we've been dealing with for a little over 12 months now in the UK. And in the inverted curve, you can imagine what's going to happen here. You're getting a higher rate for locking your money up for a shorter period of time. Now, why does that make sense and why does that happen? Well, that happens because what the market's saying there is there's going to be a recession. And what's one of the things the market expects to happen when there's a recession? Interest rates will drop, sometimes particularly significantly. So if interest rates all drop, if we have particularly high, and we've seen this at some points over the last 12 months, very high returns on bonds for 1 or 2 year duration, perhaps up to 6% or a little better for that sort of duration. But what the market is then saying, that the 5-year bond at the time might have been at 4.75%. So the market's effectively saying, right, we think there's a time in the interim where money's expensive, there's a lot of risk, there's going to be a recession, rates will drop, So the rates for that year 3, year 4 and year 5 of that 5-year bonds were much below 4.75%. The market was probably estimating they were maybe 2.5 to 3% because there'd have to be a dramatic cut. But of course, we've also got to remember that over the last 12 to 13 months, there definitely has not been stability in terms of where the market thought the peak base rate would be. We now feel like we may have seen peak base, but there's definitely cases where the Monetary Policy Committee might choose to still put the base rate up. What we probably have seen, I feel, is we've seen the peak in where the bond yields will be, particularly the 5-year, which, as I said before, I'm particularly interested in because I use a lot of 5-year fixed rate debt in my property group. So the inverted yield curve is saying there's trouble coming around the corner. And then what does the yield curve start to look like when the recession may come? Now, it's quite often the relationship between the 2-year and the 10-year bond that is looked at. And the reason for that is that there's a huge amount of liquidity in both of those markets. And the data, when we go backwards, shows that when the 2-year is returning dramatically more than the 10-year, there's a high probability of a recession coming in the near future, which may well be 2 years away, but it could be 18 months, it could be 3 years or even longer, right? What happens when we start to approach that 2-year horizon, quite often, is the yield curve starts to flatten. And that's the sign that we might well be going into recession. We're not seeing a particularly flattening yield curve yet, although it is a lot less steep than it was, say, 3 or 4 months ago from the time of me recording this video. So a better indicator, though, according to a lot of the technical analysts, is the 3-month 10-year comparison. Now, obviously, the 3-month is a lot of a closer horizon to start with, so you would expect that to be a much more accurate assessment of what's going to be happening. It's much easier to predict the next 3 months than it is even the next 2 years. And when there's a dramatic difference between the 3-month and the 10-year, there may well be imminent trouble ahead. And we've seen that happening. But as I say, we're still seeing a steeper 3-month to 10-year. We would expect things to flatten first if the UK is going to go into recession. And of course, the market, alongside a lot of the other forecasters, nearly all of us, to be honest, have really struggled to predict everything over the last 12 to 18 months. The mathematical models have broken down a bit, and that's because we've had so many things that are not particularly rich in data over the years, like massive stimulus because of COVID. Where would that money go? Nobody really knew. Massive inflation above what almost everybody had predicted. And if you remember the beginning of 2023, a lot of organisations were saying inflation would be down near the 2% mark. Now, don't worry, there will be a much longer explainer video on inflation as well in the series, so you can look back in on that one as well. Thanks for joining, and I hope that started and helped to explain the yield curve to you.